All right, let's cut through all the confusion surrounding YieldMax ETFs. You've seen the headlines, right? The crazy performance swings. And the big question on everyone's mind is, what are we supposed to do with these things? Buy, hold, sell? Let's get a clear answer.
So here's the puzzle that trips everybody up. You see these absolutely insane dividend yields. We're talking over 50% sometimes. But then you look at the fund's price, its net asset value, or NAV, and oof, it's taken a nosedive. So, are those huge dividend checks actually making you money? Or are they just a smokescreen for the fund's value disappearing? That is the exact question we're going to tackle today.
To figure this out, we can't rely on hyper-guesswork. We need a simple, objective way to look at it. So we've boiled it all down to a clear, data-driven method that really shows us the total picture for every single one of these YieldMax ETFs. Here's how we're going to do it. It's a really straightforward three-step process. First, we'll look at the fund's price change over the last year, how its NAV performed. Second, we'll stack that up against the dividend yield it paid out. And third, based on how those two numbers balance out, we'll assign a clear recommendation: buy, hold, or sell. Simple as that. Okay, let's start with the good news, the most straightforward group of all, the winners. These are the funds where the strategy is working exactly as you'd hope, leading to positive growth and, honestly, a pretty easy investment decision. Now, here's what's really interesting. You'd think there would be a lot of funds in this category, right? Well, get this. Out of all the YieldMax funds that were analyzed, only 4, just a tiny club of 4, actually managed to increase their price over the past year. And here they are: Hui, Plight, Choppy, and NFLE. These are the clear buys. And the reason is simple. Their price actually went up. Take Hui, for example. It jumped 30%. This means that massive dividend wasn't just making up for losses. No, it was pure bonus cash on top of some solid capital gains. That's a win-win. Now, let's flip the coin and look at the other side of the story, the losers. You know, these funds are designed to use options to generate income, but in these cases, that strategy just couldn't protect investors from some really steep price drops. This is the cautionary tale part of our analysis. These are the funds where the underlying asset performs so poorly that even a monster dividend couldn't drag the total return into the green. This is that uncompensated risk you always have to watch out for. So, the analysis flags 5 funds as clear sells. And these numbers are just brutal. I mean, look at MRNY. Its price completely collapsed by over 82%. For these ETFs, the conclusion is stark. The dividend was like bringing a water pistol to a house fire. It was nowhere near enough to cover the capital destruction, which means investors ended up with a major net loss. Okay, now we're getting to the biggest and frankly the most complicated category. This is the gray area, the middle ground where most of these YieldMax ETFs actually live. And this is where the decision isn't just a simple yes or no. Welcome to the great hold debate. And TSLY, one of the most popular funds out there, is the perfect example to break this down. On one hand, its price dropped a painful 40%, but on the other, it paid out a staggering 67% in dividends. You see the dilemma, right? This is the central question for every hold recommendation. Is the income you're getting worth the capital you're losing? So let's be super clear here. A hold recommendation is not a passive thing. It's not a set it and forget it deal. It's an active choice. It means you're consciously accepting this trade-off between that sweet income and the price of your fund eroding. The decision to stay in or get out depends entirely on your personal risk tolerance, and it absolutely requires you to monitor that fund like a hawk. This complex balancing act, this is where the vast majority of these ETFs sit today. So after looking at the good, the bad, and the complicated, what's the single most important thing to take away from all this? What's the bottom line for any of us looking at these high-yield products? It all boils down to this one critical point. A high dividend yield alone does not guarantee a positive total return. You cannot let yourself be seduced by that giant yield number. You must look at the fund's price performance to know if you're actually making money, because at the end of the day, total return is the only game in town.
And that brings us to the final question, which is really a question for you. Now that you have this framework, how does it apply to your own investment strategy? Are you hunting for capital growth? Are you all in it for the income? Or are you looking for some mix of both? For your portfolio, where does that balance between risk and reward truly lie?